Welcome to Stocks in Translation, broadcasting from the New York Stock Exchange, the heart of global capital markets. I'm Jared Blikre, and with me is the voice of the people. You know her as Sydnee Fried. First, please like, subscribe, and comment on Stocks in Translation on Spotify, Apple Music, Amazon, or YouTube. And today we are welcoming Michael Reinking. He's a CFA. He's also a senior market strategist with the New York Stock Exchange here. Thank you for joining us, everyone. We are going to be talking about what is in store for investors in 2025, and our phrase of the day is systematic risk. So it is wonky, and it hurts a little bit, but it could make you or save you a lot of money by decoding the fingerprints of large traders in the market. We're going to talk about it. And this episode is brought to you by the number 100 billion. That is the dollar amount of Uncle Sam's debt that is auctioning this week in long-term treasury debt. So what is the bond market saying about risk in 2025? And before we really dig in, Michael, just give us your big picture overview of what you are seeing in the markets here, and maybe especially since the election.
Yes. So first and foremost, thanks for joining us here, I guess, on my home turf. And you guys had a little bit... Yes, and you guys had the worst travel in here than I did with some snow outside. So appreciate you guys coming to visit. Yeah, look, it's been a really interesting market post-election, right? We saw, kind of coming into that election, one of the things we had talked about was there was this expectation that we would see that the election would be this volatility-inducing event. There would be a pullback heading into the election, and that never really came to fruition. And then on the back end of that, right, we saw this kind of broad rally within the market. Pretty much everything moved higher for the month of November. There was a lot of optimism about policy coming out of Washington and what that would look like in terms of kind of being a business friendly environment, kind of an improved regulatory environment, right? And then what we got when we got into December,
Disappointment.
Yeah, and then we had a little bit of shaky December, right? As you were pointing out, in that markets kind of did a little bit of a rethink, understanding that there are pretty slim margins, kind of within Congress, right? So it's going to be difficult to move some of that agenda forward. And at the same time, as the Federal Reserve was cutting interest rates, we saw, we saw rates moving higher, right? And that once again put some pressure on those kind of small and mid-cap stocks, which everybody had been kind of hoping that we would see this great rotation, kind of for the second consecutive year. And we've had fits and starts of that, but it didn't actually kind of come to fruition. And December was a pretty rough month. I mean, the S&P 500 was only down 2.5%. But if you look at
it felt a little different.
Well, it was much different. So if you look at the equal weight version of that index, it was down over 6%. If you look at the small and mid cap indices for the S&P, they were down over 7%. Right. So there was a lot of pain beneath the surface.
There's a lot to dig into here, but I want to get to our phrase of the day, which is systematic risk. And so, as I said before, this is a wonky term. Well, let me just define it here, and then we can get into why exactly it is useful. Systematic risk is the chance of large market-wide disruptions caused by broad factors like economic changes, like political events, or the predictable actions of institutional investors such as commodity trading advisors or quantitative funds. And I said this was wonky here, but why should we be thinking about systematic risk? Because it can actually be kind of telling.
Yes. So when you think about kind of systematic risk, right? We've seen markets kind of change very much so kind of over the last couple of years. We're seeing much more use of options markets, right? We see CTAs and something called the vol target funds, right? So those are funds that are deploying capital based on volatility that you're seeing within the market. So when volatility is compressed, you see kind of money, they put capital to work. When that volatility then expands, right, they begin to reduce exposure as you have a value at risk. So if you think about it, kind of in a big picture, right, they have a risk budget, so to speak. So as you see volatility pick up across equities or other asset classes, right, they have to reduce that risk budget, and you have very, very systematic flows that come into markets when you start to see trends breaking or volatility pick up, right? And that's something that we're seeing more regularly within the market. But on the back end of that, it's almost like you guys have heard of the proverbial wall of worry, right?
Sure.
This is almost a quantitative kind of wall of worry, right? So you see the VIX or volatility moving higher, and then as the VIX kind of starts to back off because it's very hard to maintain that level of volatility, you start to see that same capital that's systematically moved out of markets move back in.
So it's basically just looking at the rules and figuring out how people are playing the game.
Wait,
Exactly.
let me make sure I understand this. So systematic risk, it is measurable, and are the VIX and vol target and options, are those examples of how you can measure it?
Those are triggers that would cause some systematic de-risking within the investment community, right? There are other systematic risks, as Jared pointed out, in terms of, the economy. But this is something that you can kind of measure and watch if you're kind of paying attention to markets to understand kind of where that capital is and how that capital is flowing, and start to kind of position yourself, understanding where you are in that process.
All right, everybody's heads are exploding now, so thanks for your guess. But we want to talk about the crump trade. Everybody can kind of wrap their heads around that. What should we be expecting for the first few months here? Just thinking back to 2017, it was a very chaotic time in the beginning. Should we just be expecting more of that? Or?
Right. I mean, I think that is one of the things that I'm looking at for 2025. Right, there's so much uncertainty as we head into this year. Kind of with Washington policy, with the fact that we've had back-to-back 20% years of gains, with the fact that you have valuations which are a little bit more stretched than they have been historically. So I think we're in for a period of volatility. Unfortunately, to go back to that kind of conversation again, right? But I do think we're in for a period of volatility. If you look at 4-year presidential election cycles,
Sure.
That first quarter does tend to be one of the more rocky quarters. It's still, over time has historically been positive, right? But within that first year of the presidential cycle, it's the worst quarter of the start of the year, right? And as markets start to digest what policy is going to look like, you're going to start to kind of see all the different factors kind of start to shift.
So how does somebody prepare for that volatility? How do you hedge against it? If you're kind of just a passive investor, is there any hedging against it?
Bring it all.
Right. So I mean, I think that's so. I think the first piece of that is you have to understand like what your goal is as a trader or as an investor, right? So are you a really active trader that's kind of trading headlines on a day-to-day basis? Or are you someone who's putting your money into your 401k, right? In that case, right, there's you stick to your plan, right? You work with your advisor, you continue to put money into markets over time, right? The kind of most important factor for kind of that sort of individual is time, right? And we've heard Warren Buffett talk about that in time and time again. If you're kind of that more active investor, you can pay attention to kind of some of the things that we had just talked about, right? But I think it's also this time around may be a little bit different because we've been down this route before. So markets, right, have been seen a Trump presidency, right? We've seen kind of his negotiation style, right? And you're even getting some sense that markets are a little bit kind of desensitized, not desensitized, but they're understanding that first overture may not ultimately become policy, right? And there's something that may be something more in the middle road. So I don't know that's going to be the tweets or Truth Social is necessarily going to be kind of the driver of volatility that we saw the first time around.
What about earnings? We have those, and those have kind of taken a backseat in my mind, but they're going to be a big deal in a week or two. What are you expecting? Because financials usually kick things off, and we have huge expectations on the deregulation front, and financials have been doing pretty well.
Yeah. So I mean, I think when I think of what happens, when I look at 2025 and what's going to happen here, I think earnings is a really important key. So if you take a step back and you look at where earnings estimates were at the start of last year, right? The S&P 500, they were looking for earnings up about 10%. That's about where we are heading into Q4. But if you look at the small and mid cap indices, which is where everybody's hoping to see this rotation.
For a long time they've been hoping.
Yes. And right, so both of those indices were looking for earnings estimates that were up, call it 5 and 10, or 5% for the mid cap and 15% for the small cap indices. Right now, those earnings estimates are down 5% for both indices, right? So heading into Q4. Now, if you look forward to 2025, right, we're looking at estimates across the board for the S&P 4, 5, and 600, which are up kind of mid double digits. So it's really a prove it story, right? So if you want to see this rotation that everybody keeps hoping for, right, you need to see kind of those small and mid cap stocks actually put up earnings and perform, right, in order to be able to see that rotation, because that AI trade and that kind of tech concentration in the S&P 500 right? Those companies have been putting up, if you look over the last 2 years, their earnings are up about 50% over kind of a 2-year period, whereas the rest of those stocks that we just talked about are flat, right? So it's the earnings that are driving a lot of what's happening.
Earnings and interest rates always gets back to basics. Hold that thought. We got to take a quick break. But coming up, we're going to be talking about Uncle Sam's debt calendar, what that means for stocks, as well as a classic fundamentals versus technicals debate on today's Who Wore It Better. Stay tuned. We are back, and this episode is brought to you by the number 100 billion. That is dollars. This is the amount of long-term treasury auctions on deck this week. Significant because these rates have been pushing higher. These are long-term rates since the Fed started cutting short-term rates in September. So kind of a dichotomy there. This is top of line for bond investors, which is a staggering amount of debt that has to be issued by the U.S. to pay its obligations in higher rates that make that a more expensive proposition. So higher rates means more interest rate payments. So there are some big picture, longer term implications here, Michael. But I've also seen on a very short term basis when we have these big auctions, sometimes you can day trade around them. You know, you might get a little bit of a hiccup in the equities market if you don't get the uptake on the bond market. How are you thinking about rates?
Yes. So, I mean, you highlighted one of the biggest kind of risks that investors are dealing with right now. And that's kind of the move higher that we've seen in rates really since the Federal Reserve began cutting in September, right? So I think there have been a couple evolutions in terms of why rates have moved higher over that time period, right? Initially, right, they started with that 50 basis point cut. I think there was, you remove some of the concern that we were going to have a hard landing, right, after some weak jobs data. But since then, we've had the economic data has come in better than expected, right, in terms of, kind of economic growth. And in the labor markets, we've also started to see kind of the inflation side of things get a little bit more sticky, right? Not necessarily seeing as much disinflation as the Federal Reserve would like to see. Now, kind of coming out of that move, the other piece of what we're seeing is the move higher in term premia. So not to kind of throw another fun,
What's the? I was going to say. Well, hold on.
Another, kind of financial
what is term premium?
Yeah. So numbers. Yeah. So if you think about it it's the amount of excess interest you want to earn for owning longer term bonds, right? Just to kind of really simplify that.
Yeah. How much money is it going to take you to get into these long-term bonds?
Right. It's to own a 10-year bond versus, right, the difference that you would demand to own a 10-year bond versus a 5-year bond, right?
Gotcha.
And what we're starting to see is the term premia is started to move higher. That is in response to those deficits that you're seeing, right? And it's a very interesting dynamic because it's something that most people, kind of on Wall Street haven't really dealt with for 40 years. Right, it hasn't happened for 40 years. So, I mean, for those who are listening on podcast form, right, I have a lot of gray hair. I didn't even kind of trade through that time period, where, we were talking about, kind of bond vigilantes, right? And so the idea is that we want to see kind of coming out of those auctions, you want to see that there is demand, right, for this paper as you start to see, the auction results. So you want to see kind of, strong bid to covers. You want to see a strong indirect bid that will give you a sense that you have foreign ownership kind of coming into these bonds. And if you start to see kind of a weak auction, right, that's where there's some risk, right, because you would start to kind of push through kind of the upper ends of where kind of interest rates have been kind of comfortable, right? We've been kind of in this 4 to 5 range. We're kind of in a little bit, kind of mid to upper end of that. If we started to push through 5%, that's where I think you would really start to see some concern come into the markets.
So where do bonds fit in the average person's portfolio?
Yeah, so I would leave that really to kind of,
to the individual
investment advisor.
Yeah.
To the investment advisor, right? But I mean, the interesting thing that we're seeing now that we haven't had over the last decade, right, is that there is an alternative, right? So there is an alternative to owning equities, right? You are earning a real return, kind of for owning kind of government bonds. Last year, if you look at kind of return profiles of in kind of corporate credit, right? Corporate credit returns were very, very strong. So I do think that there is a place, there is this alternative for the individual investor, at this point where the only, equities aren't the only game in town. Sure.
Yeah, I mean, just thinking back to the 80s, with the bond levels we're talking about here in the 10 years, 4.75. They got to 15%, I think, in the early 80s, and short-term rates got to 20%. I mean, I ask you, you sat here at or near the floor for a long time. What is some of the craziest event maybe you've seen on the floor?
Well, since my time here, I mean, I guess we'd have to probably pretty much everybody would go back to that kind of that pandemic time period, right? Where we saw some market-wide circuit breakers, triggered for the first time in years, when we were down here before when we briefly closed the floor. So I mean, from that perspective, since I was here, that would have to be it. I think, if I think a little bit longer during my career, the time, that 2007, 2008 time period when I was still on the buy side and trading, where you're questioning what was happening in the financial system.
That's how I
right. That was right. That was definitely, from a trading perspective and a volatility perspective, definitely the craziest time period that I've lived through.
Turning back to the equity market, we're entering year 3, bull market.
Yes.
What would you say the odds of 20% returns for stocks? Another one.
Yeah. Look, I don't think it's out of the question, right? If you look back, I think one of the big discussions that we've had over the last year was, looking back at the 1990 time period, right? And so now we did just have that second consecutive 20% gain for the first time since the 1990s, right? There are a couple of parallels and arguments that were being made that either we were at the beginning end of that time period or the end. The first common thread is the Federal Reserve, right? Where you had kind of the first recalibration of rates, as they like to call it, or kind of an insurance cuts, right? A mid-cycle adjustment within the economy where they were cutting rates. And then the second common theme, obviously, is kind of the technological revolution, right? And now kind of AI relative to what we had seen kind of in terms of wireless and the internet boom. I've argued that I think we're in the earlier portion of that time period.
And that's important. So basically the mid 90s, because there were two kind of insurance cuts. I think one was in 95, the other was in 98, very different circumstances. But 98 was a few years closer to the end, because we know that was, 2000 basically. How do you think about these market analogs? So what draws you to that mid 90s?
Yes. So I mean, and it's an amazing period of return profiles, because you actually went almost 4 years of consecutive 20% returns in that window. I think there's some parallels and some differences, right? So if you think about all of the capital spending, which is really driving, what we're seeing in markets right now, and it's driving economic activity. I mean, that's one of the main drivers of kind of productivity growth, which is kind of a boon for equity markets, right? It's helping labor markets remain resilient, right? And it's offsetting a lot of the impact of what you would expect to see in a normal kind of hiking cycle, kind of coming from the Federal Reserve. Yeah. So that spending is happening from cash flow from these companies. It's not happening by companies raising debt, which is a very different dynamic than the last time around. And then if you start to look at kind of the sentiment, right? We've been kind of climbing this kind of, still a wall of worry, right? There's a lot of, everybody's worried about valuations. That conversation is happening, kind of over and over and over again. There's still this wall of worry, and you haven't seen a return of kind of capital markets activity to me that suggests kind of that we're at the end, right? We haven't seen this massive wave of IPOs or M&A activity, right? And those things tend to come, right, and really, really big waves of that sort of activity tend to come as you get kind of later in the cycle. We haven't seen that yet.
We're talking about the beginning of
Exactly.
IPO liquidity. All right, hold that thought here. We want to get to today's Who Wore It Better, and today we're going to get to a company. We're going to get to company fundamentals and pit them against their cousin, which is market technicals. So some investors swear by fundamentals. They analyze earnings, valuations, and guidance to find long-term winners. Others rely on technical analysis, tracking trends and patterns and sentiment to outmaneuver the market in real time. So fundamentals have that Warren Buffett-esque charm. You can ignore the noise, you can trust the intrinsic value, hope that everything comes out in the long term. But in the modern age, after the retail revolution, which we've been talking about, sometimes fundamentals might seem a little bit slow. Then we have technicals, which I'm biased. I'll admit that. Technicals bring speed, agility, and precision to the table, plus an amazing assortment of names, Sydney, from Fibonacci levels to Ichimoku clouds to Elliott waves to Chondrite waves. Any questions there? But each has their flex. So, Michael, who's wearing this 2025 market better? Is it the fundamentals, the technicals, or some holy alliance between the two?
Yeah. So, for my style and kind of where I like to look at things, it's actually kind of mending. It's the best of both worlds and being able to mend the two together, right? So, I think there's two different ways you can go about it, right? You can use technicals to identify what's happening in the market, right? Observing like kind of the story the market is telling you, and then being able to try to then go and put on your fundamental hat and understand like what are the fundamentals that are actually driving this trading activity, right? Because when you think of technicals, right, it's trend following, it's following of money flow, right? That's at its purest form, right? It's in its purest form. That's what it is, right? Now the other way you can go about it is you have your fundamental view, right, and you can use those technicals to kind of help you pinpoint when you want to put those trades on, right? And so I think if you understand both and the drivers of both, like that's kind of where I think you can be, use both. I think they both wear it well, I guess, so to speak.
Is there like a really simple technical measure that you could share that like an average person might be able to pick through? Yeah.
I mean, moving averages are an easy way, right?
I hated that joke.
But moving averages
Okay.
are very simple, right? You can use them, to have trading rules to kind of, using shorter term moving averages to understand kind of the fast trend, medium term, 50-day or 100-day moving averages to kind of more intermediate, and that kind of the holy grail, the 200-day moving average, where kind of people are focusing from a longer term perspective, and being able to manage your risk, right, as you're kind of in trending markets, as you're breaking below kind of some of the faster or more medium term, right, and trying to use kind of those moving averages to kind of pinpoint to pinpoint entry or exit levels. I think, but just like in its purest form, kind of like looking at just support and resistance, right, in a stock where where you have if you have a range, right, where a stock is traded in a range between kind of two different prices for a long period of time, you're kind of breaking out of that range, watching the price action on the back end of that, understanding that you're going to back and fill, like, that initial breakout doesn't usually just take you, kind of right straight to the moon, right. That there usually will be a little bit of a backing and filling and watching kind of the reaction function on the back of when stocks retest those prior levels to understand, kind of whether this is a good entry point or not. But when you kind of trade in that way, you have to kind of respect kind of risk parameters and stay true to kind of go into every trade with a plan, right, and kind of stay true to that plan and respect it.
Thank you. Always have a plan. And guess what? Episode number 2 from our new home is in the bag. We have wound things down here. Make sure to check out other episodes of Stocks in Translation on the Yahoo Finance site and mobile app. And we'll see you next time.